The trillion-dollar wager. Inside Bitcoin's fight for global financial power. Cinematic hook on the surface, this looks like just another market cycle. Bitcoin rose, Bitcoin fell. Headlines came and went. But beneath the price chart is something much larger. A quiet contest over who controls the plumbing of global money. Because in the space of 18 months, Bitcoin went from a fringe speculative asset to a line item on the balance sheets of public corporations, a regulated product inside America's biggest brokerages, and a subject of formal law in the United States Congress. And then it fell nearly in half. Governments did not panic. Institutions did not flee. Regulators did not reverse course. That reaction, or rather, that lack of one, may be the real story. Visual, slow zoom on a Bitcoin price chart, peak to trough, dissolving into the US Capitol building. What just happened? Let's start with the plain facts. In October 2025, Bitcoin reached an all-time high above $126,000. It was the peak of a rally driven by institutional buying, a wave of newly approved exchange-traded funds, and growing confidence that Washington was finally going to write clear rules for digital assets. Then came the reversal. Through the first half of 2026, Bitcoin drifted lower, and in June 2026 it fell sharply, briefly testing the $60,000 level, as the Federal Reserve kept interest rates elevated in the 3.5 to 3.75% range longer than markets had expected, in response to inflation that refused to cool as quickly as hoped. As of this recording, in early August 2026, Bitcoin is trading in the mid-60,000s, down roughly half from its October peak, but still holding a market capitalization above $1.2 trillion. That is the headline. But the headline is not the story. Visual timeline graphic. OCT 2025 peak, early 2026 drift, June 2026 crash, August 2026 stabilization. The backstory. To understand why this correction matters, you have to understand how Bitcoin got institutionalized in the first place. It started with the approval of spot Bitcoin ETFs, which let ordinary investors and pension funds buy Bitcoin exposure through a normal brokerage account. No crypto wallet, no exchange account, no technical risk. That single change turned Bitcoin from a niche asset into something Wall Street could hold in bulk. Then came corporate treasuries. Companies, led by the firm now simply called Strategy, formerly MicroStrategy, began buying Bitcoin directly and holding it on their balance sheets as a hedge against currency debasement. By late 2025, more than 200 public companies had followed some version of that playbook, collectively holding an estimated $150 billion in digital assets. Then came the law. In July 2025, President Trump signed the Genius Act, the first major federal legislation governing stablecoins, the dollar-pegged digital tokens that move value across crypto markets. It required stablecoin issuers to hold real reserves and answer to federal regulators, effectively inviting banks and fintechs into a market that had operated in a gray zone for a decade. Then, in March 2026, regulators went further. The SEC and the CFTC jointly classified 16 major crypto assets, including Bitcoin and Ethereum, as digital commodities under CFTC oversight rather than SEC securities law. It was the regulatory clarity the industry had wanted for a decade. So by early 2026, Bitcoin had ETFs, corporate balance sheets, and a legal framework. It had, in other words, been absorbed into the machinery of traditional finance. IBCD ETFs opened the door for institutional money. Corporate treasuries turned Bitcoin into a leveraged equity story. Congress and regulators wrote the rules. And then the same institutional structure that powered the rally amplified the fall. Chain-link graphic connecting ETF approval, corporate treasuries, Genius Act, CFTC, SEC framework. The players. Every major story like this has a cast of actors, each with a different stake in the outcome. The Federal Reserve wants price stability first, growth second. Its decision to hold interest rates higher for longer in the face of sticky inflation drained the easy liquidity that risk assets like Bitcoin depend on. The Fed is not targeting crypto specifically, but crypto is one of the most sensitive instruments to what the Fed does. Corporate treasury companies, led by Strategy's executive chairman Michael Saylor, want Bitcoin to keep rising because their entire business model now depends on it. Strategy holds more than 800,000 Bitcoin, acquired at an average cost estimated around $75,000 to $76,000 per coin. When Bitcoin falls below that average, the company's holdings show paper losses that flow directly through its earnings under current accounting rules. Congress and financial regulators want durable rules that keep the United States as the center of digital asset innovation, without inviting another crisis. That is the balancing act behind both the Genius Act and the market structure legislation still moving through Congress known as the Clarity Act. Institutional investors and ETF holders want exposure to Bitcoin's long-term upside without the operational risk of holding it directly. And ETF inflows have, at times in 2026, run into the hundreds of millions of dollars in a single day, evidence that this group hasn't left even as prices fell. Retail investors and the broader public want a stable, accessible way to participate. And they are the group most exposed to volatility, since they typically buy near the top and sell near the bottom. Each of these players is chasing something different: stability, growth, legitimacy, exposure, participation, and their incentives don't always point in the same direction. Visual, split-screen graphic of the 5 player groups. The hidden force. Here is the deeper force running underneath all of this. Bitcoin has stopped behaving like a rebellion against the financial system and started behaving like a leveraged bet on it. For years, Bitcoin's core pitch was independence, a currency outside the control of central banks and governments. But the mechanisms that brought Bitcoin into the mainstream, ETFs, corporate treasuries, federal regulation, are the exact opposite of independence. They are integration. That integration cuts both ways. It gave Bitcoin legitimacy, liquidity, and access to trillions of dollars in institutional capital. But it also tied Bitcoin's fate more tightly than ever to the very system it was designed to sidestep: interest rates, inflation data, and the balance sheets of a handful of large public companies. This is why the June 2026 crash tracked so closely with Federal Reserve policy. An asset that was supposed to be immune to central bank decisions is now one of the more sensitive instruments to them, because so much of its ownership now sits inside institutions that borrow, leverage, and mark to market like any other financial firm. Visual, 2 overlapping circles: Bitcoin as independence and Bitcoin as institutional asset, increasingly merging. The money trail follow, where the capital actually moved. Who was paying? Institutional buyers, corporate treasuries, and ETF investors, pouring capital in through 2025 as prices climbed toward $126,000. Who was receiving? Early holders and long-term accumulators who sold into the rally, along with the exchanges and fund managers collecting fees on record trading volume. Who benefited most? Companies like Strategy in the short term, whose stock became a leveraged proxy for Bitcoin itself, rising far faster than Bitcoin on the way up. Who now carries the risk? Those same companies on the way down. Reporting in mid-2026 estimated that the June correction alone wiped out roughly $62 billion in combined market value from public companies holding Bitcoin as a treasury asset, with Strategy, Tesla, and Marathon Digital among the hardest hit. That is the core mechanic of a leveraged proxy. It doesn't just track the underlying asset, it amplifies it, in both directions. Meanwhile, the stablecoin market, the dollar-pegged tokens that move value across the crypto economy, has grown to an estimated $300 billion plus, now placed under the direct oversight of federal banking regulators for the first time. That is arguably the more consequential money trail, because stablecoins are less a speculative bet and more a rewiring of how dollars move around the world 24 hours a day without needing a traditional bank in the middle. Visual, animated flow of capital, ETF inflows, corporate purchases, stablecoin settlement volume. The second-order effects. If this pattern continues, what changes next? For markets, Bitcoin's price action is likely to keep correlating more closely with interest rate expectations and broader risk sentiment, less like digital gold, more like a high-beta tech stock. For corporate treasuries, Companies that adopted the hold Bitcoin forever strategy face a genuine test of that model. If prices stay depressed or fall further, some of these firms may be forced to sell assets, dilute shareholders further, or restructure debt. A scenario strategy's own leadership has publicly acknowledged planning around. For regulators, the coming months matter enormously. 6 federal agencies are working to finalize Genius Act implementation rules by a July 2026 deadline, with full enforcement targeted for January 2027. If that timeline slips, and historically, similar deadlines under laws like Dodd-Frank have slipped before, the stablecoin market could temporarily fragment between compliant and non-compliant issuers. For everyday users, clearer rules, if they arrive on schedule, could make stablecoins a genuinely mainstream payment tool, useful for remittances, business settlement, and dollar access in countries with unstable currencies, rather than primarily a trading instrument for crypto speculators. For the United States more broadly, the underlying policy goal, expressed repeatedly by lawmakers writing this legislation, is to keep dollar-based finance, even in its digital form, at the center of global money movement, rather than ceding that ground to other currencies or systems. Visual branching diagram: market path, corporate path, regulatory path, consumer path. What most people are missing. First, most coverage frames this as a story about whether Bitcoin's price will go up or down. But the more interesting question is about ownership structure. A growing share of Bitcoin now sits inside ETFs and corporate treasuries, meaning its price increasingly reflects institutional balance sheet decisions, not just individual belief in decentralized money. Second, the fixation on Bitcoin's price obscures the stablecoin story, which may end up mattering more. A $300 billion-plus market of dollar-pegged tokens, now regulated for the first time, is quietly becoming infrastructure for global dollar settlement, a development with far broader economic reach than Bitcoin's price swings. Third, the corporate treasury model, buy Bitcoin, hold it forever, borrow against the rising value, was built on an assumption that Bitcoin would trend consistently upward. The June 2026 losses were the first real test of that assumption at scale, and the test is not over. Fourth, regulatory clarity is not the same as regulatory certainty. The frameworks passed so far, the Genius Act, the CFTC, SEC Digital Commodity Classification, reduce ambiguity, but implementation deadlines, agency capacity and political timing around the 2026 midterms could all still produce delays or disputes that markets haven't fully priced in. This is where the headline becomes misleading. What most people are watching is the price. What they should be watching is who owns Bitcoin, how leveraged that ownership is, and whether the regulatory scaffolding holds together on schedule. 3 possible futures. Scenario 1, base case. Bitcoin trades in a wide, choppy range through the rest of 2026, broadly tracking Federal Reserve policy. If the Fed begins cutting rates as inflation eases, Bitcoin likely finds support and grinds higher. If inflation stays sticky, it likely stays pressured. Most analyst ranges for the remainder of 2026 cluster somewhere between the mid-60,000s and low 6 figures, though these are estimates, not certainties, and forecasts across major platforms currently disagree by tens of thousands of dollars. Scenario 2, bullish case. The Fed pivots to rate cuts sooner than expected, the Genius Act's remaining rules land on schedule, and the Clarity Act passes before the November midterms. Institutional flows accelerate, corporate treasuries stabilize, and Bitcoin regains ground toward its October 2025 highs. This scenario depends on multiple things going right at once: monetary policy, legislative timing, and continued institutional appetite. Scenario 3, bearish case. Inflation stays elevated, the Fed holds rates higher for longer, and one or more leveraged corporate treasury holders is forced into distressed selling. That kind of forced liquidation could push Bitcoin toward the $50,000 to $55,000 zone that some analysts have flagged as a longer-term support level, and could also delay momentum on pending crypto legislation as lawmakers face pressure to add investor protection safeguards. None of these are predictions. They are the boundaries of what currently looks plausible based on the forces already in motion. Visual three-path branching chart radiating from the current price. The bigger picture, zoom out far enough, and this stops being a story about Bitcoin at all. It becomes a story about how the modern financial system absorbs disruptive technology. Bitcoin was born as a challenge to central banks and traditional finance. 15 years later, it has a listing on major stock exchanges through ETFs, a place on corporate balance sheets, and its own chapter of federal law. That is not failure. It is not exactly victory either. It is something more familiar in financial history. The system doesn't defeat the disruptor, it incorporates it. Railroads, radio, the internet itself, each began as an outside force and ended up woven into the existing structures of capital and regulation. The deeper question this raises is about power. If Bitcoin and stablecoins become core infrastructure for how money moves globally, the country that writes the rules for that infrastructure, reserve requirements, custody standards, who gets a banking charter, holds real influence over the next era of finance. That is very likely why Washington moved as quickly as it did on the Genius Act and the Digital Commodity Framework, not just to protect consumers, but to make sure the rules of digital money get written in Washington, not somewhere else. Visual world map with capital flows converging on US financial centers. Final takeaway. So why does any of this matter, beyond the price on a chart? Because what's being decided right now, in Federal Reserve meetings, in corporate boardrooms carrying billions in Bitcoin exposure, and in congressional committee rooms, is not just whether one asset goes up or down. It's who gets to define the next generation of money and under whose rules it operates. Bitcoin promised an exit from the traditional financial system. What it may have built instead is a new, faster wing of that same system, with the same forces of leverage, regulation, and institutional power now running through it. The price will keep moving. That was never really the point. What's worth watching is who's still standing when it settles.